Welcome to Managerial Accounting. Today is day 17 for the fall 2022 semester. And as usual, we will start with talking about what's due, what's coming up, so that you can see where we're going from here. You can see, looking at the course schedule in Brightspace, that's what's showing on the screen right now, that we're going to finish up chapter 22 today. We do have a bunch of exercises. We have 7 exercises to finish, but we should have plenty of time to do that within our hour and 40 minutes of class time. So assuming that that happens, you should be submitting your chapter 22 exercises for grading by the end of the day to be on track with that. And then you also know that our exam, not including chapter 22, but it's chapters 19, 20, and 21 are on exam 2. And that exam is due on Sunday before the end of the day, along with the extra credit, which is the reciprocal allocation method that we did, reciprocal services. And so if you want to do that extra credit, that also should be submitted by Sunday. And I have a due date on the practice set, but as the name implies, it is just practice. It doesn't count directly towards your grade. It should help you with the exam. And so I put a due date on it just to keep it here in your mind of Sunday. You can do it or not do it. It's totally up to you. Yesterday, we had a review session. And although it was not well attended, we did have the session. And so if you look here, this is the reference materials area. And I did record that review session. It is linked right here, just after chapter 21, so that it's kind of bookending those chapters that are on exam 2. In that review session, it ran about an hour and 15 minutes. Unfortunately, I ran out of time because I had to get to my next class yesterday morning. But we did go over all of the problems in the practice set from chapter 19 and from chapter 20. There were a couple problems, 3 problems from chapter 21. We did not have time to complete those together, but we did look at and talk briefly about each one, so that you should be able to do those. My hope is, because chapter 21 is what we just did last week, it's a little fresher in your mind, and it's also, I think, a little bit less challenging maybe than what we did in chapter 19. So if you're working on the practice set, please use the video as needed to help you with that, specifically for chapters 19 and 20. And if you get stuck on something from chapter 21, just let me know and I'll be glad to help you with that as well. It just didn't have time to make it into the video. Also, someone who's here in the classroom just asked about the chapter 21 mastery problem. And so I wanted to make sure, because I hadn't said this in class, I wanted to make sure that everyone noticed in the reference materials area for chapter 21, there is a video for help with that chapter 21 mastery problem. So if you're stuck on that problem, I would encourage you to watch the video first. And then if you're still stuck, let me know. And again, I'm happy to help with that. You just need to let me know. But the first step is to watch this video while you're trying to work on the problem if you're stuck. I always encourage you to try it on your own first, then go to your resources like this video. Then if you're still stuck, come to me for help. Someone had also asked about whether there would be a help video for the chapter 22 problem. You can see that there's not one in that folder right now. What that typically means is that that problem wasn't particularly challenging. And so nobody has asked for that before. So if you get stuck on that problem and you need help, you just need to let me know. We can schedule something. This chapter, as you know, is not on this weekend's exam, so we can afford to wait until next week for that, give you a little bit more time. The problem isn't even due until Tuesday, so your focus should be first on exam 2 and the 3 chapters that are on that exam. Make sure that you're comfortable with all of that material. Okay, so there's my what's coming up, what's due next. Any questions on any of that? Also, just a reminder about that review session, and I say it at the beginning of the video, but it bears repeating. Many of those exercises are algorithmically generated, so it is likely that the numbers that were in my exercises that I was doing in that review session, the problems are exactly the same, the numbers may be different. So the techniques, the calculations that I do will work, but you may need to use your own numbers that are in your exercise. You should also be able to do, if you wanted, you should be able to repeat those practice exercises an unlimited amount of time. So I have had people tell me before that they'd like to start over from scratch and try again. You should be able to do that. And it should just give you a blank slate to start over. But it will be the same numbers. I do have them set so that they don't regenerate. If you do a second attempt, you still get the same values in your second attempt. I don't know if that's the best way. If you have an opinion about that, you can let me know. So last class, we started chapter 22 on budgeting. Again, not on the exam this weekend, but we need to keep moving forward. So what we talked about specifically in class was the need for budgeting. We used some different terminology such as baseline budgeting, zero-based budgeting. We talked about participative versus top-down kind of budgeting, where we're seeking the participative budgeting, which is much more likely to be effective and useful. It seeks input from the people who are expected to implement that budget to make it happen. And so I would advocate for zero-based budgeting, where you have to justify your budget. You don't automatically get in the budget whatever you had last year and then some adjustment upward from there automatically. And I would also argue for participative budgeting as being a more effective way of getting a realistic budget, getting the buy-in from the people who are expected to make it happen. We then talked about the order that budgets would be prepared. So when we're talking about a master budget, we've got a budget committee who are responsible for ultimately for the production of that budget, for gathering all the necessary information. And when we are putting that master budget together, it consists of the operating budgets as well as those budgeted or pro forma financial statements. Our operating budgets, as we talked about on Tuesday, are always going to start with sales, because we are really trying to promote the idea of pull-through production. Why do we make the product? Because we can sell it. Not because we have capacity, not because we can, not because we don't want machines sitting around idle, but because we have a market for it, because we believe we can sell it or we have an actual order for it. So all of our budgets should start with sales, our projection of what do we expect to sell. That sales budget is going to include both units and dollars. We cannot separate those two, because how many we can sell is very much tied to how much are we expecting to charge for the product. So in class together last time, we did, here we go, exercise 2, where we put together the sales budget. And then once we have a sales budget, we can, you're welcome to close the door if you'd like. I have no idea what that noise is. Once we have the sales budget, that feeds into our production budget. And the production budget is going to be just in units. How many units do we need to produce to support the expected level of sales? Once we have the production budget, then we can move ahead to both the direct materials and direct labor budget. And last class, we talked about who's going to provide the information for these budgets. So we're getting information from our supply chain or purchasing folks about the cost of our direct materials and anything else we might need to know, like lead times and things like that. We're getting information about what direct materials we need from the design team or engineering. We are, for the human resources, or for the direct labor part, we're going to get information from human resources about how much we're paying our workers on average. And we're going to get from, again, the design or production staff, how much time do we need? How many labor hours do we need to produce this product? Last thing that we did on Tuesday, and then we'll get started with our new exercises for today, is the concept of a static budget versus a flexible budget. So we did this in exercise 1. The importance of recognizing that if our level of production, if how many units we're producing changes, we would expect our variable costs to change. And so we want to reward appropriate behavior by our managers who are expecting to implement these budgets. And if we want to do that correctly, we need to take into account that maybe we didn't make as many units as we expected to. Maybe we made more or less than that, and we know that the variable costs are then going to change. But the fixed costs would remain constant throughout, regardless of our level of production within our relevant operating range. So with that as our backdrop, that's everything we talked about on Tuesday and review the 3 exercises we completed. We're going to move ahead then to exercise 4, which is the direct labor budget. But does anyone have any questions from Tuesday? Any questions from the first part of the chapter? Did we? God bless you. We did, right? We completed exercise 3 together?
I don't think so.
No? Okay. Okay, so maybe we didn't complete exercise 3 together. I thought we had done it at the end of, did we talk about it?
I don't think that's correct.
Okay. I must have been crazy when I wrote my notes. And so that means that, because I'm pretty sure that in the announcement, I also said we did exercises 1, 2, and 3. So I apologize. We'll start with exercise 3. I know we talked about being able to do direct materials and direct labor at the same time, but I completely believe that we didn't do it. And we will start with exercise 3. Anticipated sales for Safety Grip Company were 42,000 passenger car tires and 19,000 truck tires. Rubber and steel belts are used in producing passenger car and truck tires as follows. And we've got the direct materials that we expect to use, both the quantities and then the prices. Now, I know we talked about, or I mentioned last class, that our next chapter, the chapter we're going to cover next week, is on evaluating variances from standard costs. So just to kind of give you a preview, these are the standards. This is the amount we expect to use of each one of those products and their price per unit. So in our next chapter, we'll be looking at comparing our actual results to these budgeted or planned or standard costs. It also gives us here the desired ending inventories and how much we expect to have on hand at the beginning of the month. That's going to be important for our purchases, because as we saw when we talked about the production budget, we need to take into account how much are we going to have at the beginning of the year, how much do we expect to have at the end of the year, any changed or planned changes in our inventory as we determine how much we need to produce, and in this case, how much we need to purchase of the raw materials that go into our product. And so we'll start with the rubber and the pounds required for production. So we expect to sell 42,000 passenger tires and 19,000 truck tires. So for the passenger tires, 42,000 passenger tires. How much rubber do we need? 35 pounds per unit. 42,000 tires at 35 pounds of rubber. We need 1,400,000. Oops, 70,000 pounds of rubber. Let me go back up here for a second. I just want to point something out to you. This says anticipated sales. We're assuming then we are assuming then that I wanted to make sure I wasn't missing something, that we are producing exactly the same number that we plan to sell. Now, we saw in exercise 2 that that's not always, in fact, it's frequently not the case. But it doesn't tell us anything about a change in the actual inventory of the finished product. So we have to assume that they're producing because they have a buyer, right? That we're going to match our production to the sales. In reality, that may not always be the case. Because we're on the passenger tire line, let's go over and do steel belts. Again, 42,000 passenger tires we expect to produce. I wish they had that labeled differently. And each of those passenger tires takes 5 pounds of steel belts. So we will need 210,000 pounds of steel belts for that production. Let's move on to our truck tires then. Go ahead and do that on your own, knowing that we anticipate making 19,000 truck tires. And so even though we're making fewer of the truck tires, they take more than twice as much material for rubber and about 60% more steel belts. And so we can see our amounts that we need to support that production. We also know that we need to have some, or want to have some of each of the materials left at the end of the period. And it tells us the desired ending inventory right here. 40,000 pounds of rubber, 10,000 pounds of steel belts. And so if we add those together, and I know I said this in class last time, I don't like the way they have this line titled. Same thing was true in the exercise that we did together on Tuesday. I don't think it should say total pounds available. That's misleading. I think it should say total pounds needed as opposed to available. Oops. And so we need to have 2,992,000 pounds of rubber available to support our production and give us the desired ending inventory. But we do have some expected inventory from the beginning of the year. So that represents amounts that we don't have to buy because we already anticipate having them on hand. And if it helps you to remember, we're going to subtract. What just happened? What on earth? Okay. So apologize for that. I have no idea if I hit some kind of a kill button or what happened, but we're back. Make sure we're still recording. Okay. So if it helps you to remember to subtract that estimated beginning inventory, you certainly can put the negative sign there. So we need to have about 3 million pounds available throughout the month, but 46,000 pounds we are already expecting to have at the beginning of the month. And so we will need to purchase 2,946,000 pounds of rubber. And we expect to spend $1.20, excuse me, per pound of rubber. And I think they put an extra 0 in there. And so our direct materials budget is going to include $3,535,200 that we need available to spend on our purchase of rubber. Go ahead and do the same calculation for the steel belts column if you haven't already. And so these numbers, when we combine them, are going to feed into our cash needs budget. So we said one of those pro forma or budgeted financial statements that we need to produce is our cash budget. We need to know how much cash we need available. This also includes information that's going to be shared with our purchasing or supply chain people. They need to have a line on suppliers. We need to let the suppliers know potentially that we're going to be ordering about 3 million pounds of rubber. So that's going to be helpful for the suppliers to know that. It might be that there's a lead time on this product, which means we need to place our orders maybe some number of weeks prior to wanting delivery of those products. So we might go ahead and place our purchase orders now with delivery dates timed throughout the year or throughout the period. So lots of helpful, useful information here for the planning process outside of the budget as well. It's not enough just to calculate this information. It needs to be shared. We talked about the importance of communication on Tuesday. This information needs to be shared with not only the budgeting people, but also the people who are going to expect to buy this material and the people who we expect to pay those invoices when they come due. Did I add wrong? Okay, I apparently added wrong. 3826 400. There. Sorry, I added wrong across. Apparently I must have typed that into my calculator wrong. Oh yeah, I missed a number. Okay, any questions about direct materials budgets? So this is a purchase budget, but it really includes the usage budget as well. This represents the amount we plan to use. This represents the amount that we need to buy. And this represents the cash that we need available. So our direct materials budget is going to include, as you can see, both units and dollars. The dollars are also going to be helpful in setting our expectations for how much it's going to cost us to produce the product and therefore feeding into the cost of goods sold piece as well. And if there aren't any questions, we'll keep going. So as we discussed, excuse me, on Tuesday, this direct labor budget really could be prepared at the same time as the direct materials budget, because the information that is needed for this direct labor budget comes from the production budget, which we've already done. Remember, we did sales and production first. So we needed that production budget, but we don't need the direct materials information to do this. And the people we're going to ask to provide input on this budget are not the same people that are providing input for the direct materials budget that we just did. Ace Racket Company manufactures two types of tennis rackets, the junior and pro striker models. The production budget for July for the two rackets is as follows. And so we've already, as I pointed out, we've already determined how many units we need to make. How did we know how many units we needed to make? Well, we had already forecast how many units we expected to sell. And we figured out from that sales budget how many units we would need to make to support that. Both rackets are produced in two departments, forming and assembly. The direct labor hours required for each racket are estimated as follows, and we have the number of hours for each department for each product. How do we know that? Well, the people who designed the product, the engineering staff, and the production people combined to determine how long is this going to take. If this is a product that we make all the time, we would just look at, well, how much time did it take last year on average per unit? And so these are what I refer to again as our standards, which is our budgeted expectations. We then also have the direct labor rate for each department. How do we know that? Human Resources told us. Here's how much we pay the workers in the forming department on average, and here's how much we pay the assembly department on average. In case you're not aware, New York State's minimum wage is going in this area is going up to $14.20 the first of the year, just FYI. So now we can start to construct our direct labor cost budget. So we start with hours, and for the junior racket. So let me see if I can get this positioned. Okay, so we expect to produce 1,500 units of the junior racket, and each one of those takes 0.16 hours on average in the forming department. At 0.16 hours each, it will take 240 hours in the forming department for the junior racket. 1,500 rackets at 0.24 hours in the assembly department means 360 hours worth of labor needed in the assembly department. We'll do the same thing for the Pro Striker model, knowing we expect to produce 6,200 units of that. And then we can add those together to get the total number of labor hours needed in the forming department and in the assembly department. Let's go ahead and finish this up based on how much we expect to pay workers in the forming department and in the assembly department. And then we'll talk about the implications of this information. So what do we do with this? How does this help us? Make sure I did my math right. So what do we do with this information? Well, once we have this all compiled, we want to go back to the people who provided us this information. That would be Human Resources in part. And let's take a look at what this means. So in the forming department, we need 1,480 hours. If our workers work an average of 40 hours a week, which is a full-time job, that means we need 37 FTEs. I don't know if you're familiar with that acronym FTE, but it stands for full-time equivalent. And so based on our budget here, we need to have 37 full-time equivalents, meaning full-time employees, or maybe 2 part-time employees make up a full-time employee. So that's why we use the term FTE, full-time equivalent, because we may not employ only full-time workers. Maybe we have some workers who work part of their day in forming and part of the day in assembly. They're kind of floaters. Maybe they cover people's breaks and vacations or whatever. In the assembly department, we know we need 2,220 hours, which is 55.5 full-time equivalents. And so knowing this in the budget is going to be really beneficial to go to our management, to go to Human Resources and say, we need to have 55.5 FTEs in the assembly department, Right now, we have 57. We need to have a plan for what we're doing with those other workers. Maybe we have 70. And we might need to think about shifting those workers to other areas of the plant, or I don't know, are we looking for voluntary furloughs or layoffs or something like that? On the other side, maybe in the forming department, we say, hey, we need 37 FTEs. Right now, we only have 34. We either need to try to hire 3 more workers and get them trained, or we might need to reflect the need for overtime in our budget. If we only have 34 workers, we might need to build in some overtime, because right now this is based on this hourly rate of $18 and $14, I assume is straight time. Included in that 40 hours. And we would know if we only have 34 employees, we would need more than that. This direct labor cost is going to feed into our cost of goods sold budget. It's going to help for our cash budgeting needs because we need to be able to pay our employees that amount. And it's going to help for the hiring process as well. Make sense? Okay. So again, we need to keep those avenues of communication open. We need to gather information from the people that are affected by this, and then we need to feed back to them the results. Here's what you told us, here's what that means. For the moment, I'm going to skip over exercise 5. Now, you will need to complete this, but it includes, as you can see, a production and a direct labor cost budget. We've done both of those already. And so, hold off, make sure that we cover all the new material, and we'll come back to that if we have time at the end of class, or I'll ask you to complete that on your own. And let's move on to exercise 6. So we know, we learned in chapter 15, the very beginning of this semester, 8 weeks ago now, if you can believe it, we learned that all products include 3 types of cost: direct labor, direct materials. We've just done the budgeting for that. The third piece was factory overhead. And so that's going to be our next budget. It's the next in line. Now that we know how many units we're going to produce and how many employees we're going to have, we can prepare the factory overhead cost budget. So we're given a series of costs here for anticipated production for the month of August. So this is a smaller version of the budget. Remember, we talked about last class that you've got that master budget that maybe gets shared with upper management, with the board of directors of our company. But the people who are actually on the floor need the information at a different level. And so they don't need to know how much do we expect to sell this year, but how many units do you want me to produce on Tuesday or next week or next month? And so here we have a budget that's just for 1 month. And you can see that this is a combination of both variable and fixed costs. We're asked to separate those costs for the purpose of this budget. It tells us that only factory insurance and depreciation are the fixed factory costs. I can also see, just scrolling down this list, that there are some items on here that are not part of the factory overhead. So that's unnecessary information. It's not going, for now, it's not going to be included in our factory overhead budget. So looking down this list, what do you see that is not part of factory overhead? Looking at this list of expenses, which of these is not part of factory overhead? We can go down the list one at a time if that's easier.
Would it be the sales commissions?
Okay, so sales commissions, that's a selling expense. That's not part of the product cost. So that's one. What else?
Materials management wages too?
Materials management would be part of the product. So if we weren't making the product, then we wouldn't have to have a warehouse staff. Those are probably the people who are in charge of the warehouse, the storage and usage of materials.
Okay.
But I see two others.
The production supervisor wages.
No, because again, if we weren't producing the product, we wouldn't have to have a production supervisor. So that's definitely part of the cost of the product.
The depreciation's part of it, isn't it?
It's part of it because it's factory depreciation.
Right.
So if we have an office, the depreciation on the office building and the equipment and such and computers, that would not be part of factory overhead. But yes, factory depreciation is definitely part of the product
Would
cost.
the advertising,
Yep, so advertising is also a selling expense, so that's a period expense, not part of the cost of the product. And there's one more,
Executive officer salary.
exactly, another period expense or operating, selling, general and administrative expense. These do need to be budgeted, but they don't belong in the factory overhead budget. All of the remaining costs that are listed there are part of the cost of producing the product. Now, I need to clarify that this one right here, power and light, I'm assuming that that is a sole expense for the factory. If we had a combined power and light bill that covered both the factory and the office, we would need to use some mechanism to separate those into, here's the office because that's a period expense, and here's the factory. It doesn't say that, so I'm going to assume that this power and light is for the factory only. And so whoops, sorry, I'm trying to get rid of those X's. And so we're told that the factory insurance and depreciation are the only fixed factory costs. So I'm going to go ahead and put those in down here under fixed factory costs. It also does not tell us that we have any mixed costs, but as we've discussed in the CVP analysis chapter to start, power and light or utilities typically are mixed costs. So we're going to treat it as completely variable because that's what it says here. But in reality, we would probably need to split this power and light into which part is fixed and which part is variable. So what do we have left for our variable factory overhead? We're not including advertising expenses, manufacturing supplies. So supplies, remember, are things that we use up in the normal course of operations, but they don't become part of the product itself. So we use them up, but they're not raw materials. They don't become part of the product. We have power and light. We said sales commissions are not included. Factory insurance is fixed, so we're down to production supervisor wages. Now you'll notice that those that doesn't say salaries. If they refer to that as salaries, that should be a fixed cost. Because it says wages, we assume they're being paid by the hour, and that the more we produce, the more wages, the more hours that our production supervisors are going to work as well. Same thing for the production control. And then finally, the materials management wages. So go ahead and total those. And then add the fixed and variable together. And we have our total factory overhead. We combine that with the direct materials and the direct labor that we've already budgeted. We can now calculate a cost of goods sold budget. That cost of goods sold budget is going to help us with our income statement that we're also going to be budgeting. Everybody good so far? And here we are at a cost of goods sold budget. So we know in order to do this cost of goods sold budget, we would already have completed the sales, the production, the direct materials, direct labor, and overhead budgets. All of that information is going to help us to complete this cost of goods sold budget. And that, the cost of goods sold budget, is necessary for us to do what comes next. The operating expense budgets, so selling, general and administrative expenses, and then finally, those pro forma or budgeted financial statements. So let's take a look at the cost of goods sold budget. Use the preceding information to prepare a cost of goods sold budget for June. For those boxes in which you must enter subtracted or negative numbers, use a minus sign. So that's good to know. Delaware Chemical Company uses oil to produce two types of plastic products, P1 and P2. Delaware budgeted 35,000 barrels of oil for purchase in June for $90 a barrel, and they budgeted direct labor in the chemical process was $240,000 for June. Factory overhead was budgeted at $400,000 during June. The inventories on June 1st were estimated to be, so oil is our raw material, then how much P1 and P2 we have available as finished goods, and there's our work in process. And here's how much we want to have available at the end of June. So this is very similar in terms of what we're doing to what we did back in chapter 15 when we talked about calculating cost of goods manufactured and cost of goods sold. Now, instead of reporting on what did happen, we're budgeting for what we want to happen or anticipate happening. So we start with our finished goods inventory. For the purpose of this exercise, we're going to be budgeting, or we're going to be combining together the dollar amounts for P1 and P2. So we're not doing separate budgets for each one. We could do that. We might need that level of detail to do more of a detailed analysis of the profitability of each product, for example. But for the purpose of this exercise, we're combining P1 and P2 together. So at the beginning of the month, we have available $8,300 worth of P1 and $8,600 worth of P2. So combined, that would be $16,900 worth of finished goods inventory at the beginning of the month. So that's what we started with. The next little bit here is going to be to calculate what did we add to that. So if you think back to that flow chart, is that big enough, or do you want me, I can make that a little bigger? It looks like, whoa, that's super big. Is that easier to see? Okay. My screen is really big, so here it looked really big to me. So didn't until I saw people trying to see the front screen. So we started with 16,900 in finished goods. I started to say, remember back that flow chart that I had, the hand-drawn flow chart. I told you it was a photograph of what I had drawn on the whiteboard in the classroom. And so that's really what we're doing here, is analyzing the flow of costs in and out of the finished goods inventory account during the month. So we started with 16,900 in there. That's combined R1 or P1, whatever it was, P1 and P2, R1 and R2, whatever it was. Now we want to know, what did we add to that? Well, what gets added to our finished goods inventory is the new product that we complete during the month. So now we're going back to that work in process inventory. So it tells us here that we had $12,900 worth of work in process already, or still in process at the beginning of the month. What did we add to that? Well, we add direct materials, we add direct labor, and we add overhead. So first, the direct materials. How much direct materials did we use? Well, we have to calculate that as well. Our direct materials inventory at the beginning of the month, right here, $15,200 worth of inventory we had available at the beginning of the month. What did we add to it? Our purchases. Delaware budgeted, planned to purchase 35,000 barrels of oil during the month of June for $90 a barrel. And so included in our budget, $3,150,000 of new crude oil or new raw material. So this is how much, if we add these two together, that tells us how much we had available for use during the month. Or I shouldn't talk about it in the past tense, because this is a budget. How much we will, or we anticipate having available for use during the month of June. Everybody good up to this point? How much do we expect to have left at the end of June? Right here, desired inventories at the end of the month, $16,100 worth. So how much do we expect to use? Well, if we expect to have $3,165,200 available for use and we want to have $16,100 worth left, we must plan to use $31,49,100. And I need to put the negative in there because it told us to use a negative when we plan to subtract or when we need to subtract. So now that I've done that, let me just recap what we did. In the work in process inventory account, we started with $12,900 in there. That carried over from May. During the month, we plan to add another $3,149,100 worth of direct materials. And we're going to add direct labor and overhead. So how much direct labor? It tells us right here, direct labor budgeted in the chemical process was $240,000 for June. So we're going to add that. How much overhead? Factory overhead was budgeted at $400,000 during June. So the total manufacturing costs that we anticipate adding to work in process during June includes the direct materials, the direct labor, and the overhead. So we need to add those three pieces together. Direct materials, direct labor, and overhead. And that's how much we're adding to the account during the month. But remember, we already had $12,900 in there at the beginning of the month, or we expect to have at the beginning of the month. So the total work in process during the period is what we started with, $12,900, plus what we added to it, $3,789,100. Add those two together, $3,802,000. So that's how much was in process during the period. Did we finish all, or do we expect to finish all of it? No, right here, it tells us the desired inventory on June 30th for work in process. End of the month, we expect to have 13,500 left. So that represents the ending work in process. That's the amount that we didn't finish. So how much did we finish? 3,802,000 minus the part we did not finish. $3,788,500 represents the value of the work that we did finish. The total P1 and P2 that we expect to complete during the month. When we finish it, what do we do with it? We move it into finished goods. At the beginning of the month, we already had $16,900 worth of finished goods. Remember, that was the combined P1 and P2 at the beginning of the month. Add to that the part we finished or expect to finish in June. And that tells us our total finished goods available for sale. What did we start with? What did we add to it? Do we expect to sell all of that during the month? No, because right here, we're told, here's how much P1, here's how much P2 we anticipate or we want to have left at the end of June. Add those two together, $17,300 is our expected finished goods ending inventory. And we need to use the negative to show that we are subtracting that value to get our cost of goods sold. And so, as I said, there's really not anything new in this exercise. We've done exactly this starting in chapter 15. The only difference is we are now forecasting or projecting or budgeting for what's going to happen or what we think is going to happen in the future. And what we did starting in chapter 15 was what already happened, what happened in the past that we were reporting on. These are budgeted data. These are budgeted data, but the process that we followed to get to from the beginning to the end is not anything new. And if you're unsure about this, I would encourage you to go back to that flow chart that's in maybe the chapter 16 reference materials. If it's not there, it's in chapter 15, but I think it's in chapter 16. Questions, anybody? Questions? All right. Let's keep going. So, excuse me. So this cost of goods sold, about $3.8 million, is going to feed forward into our next budgets, okay, into our budgeted or pro forma income statement specifically. It's also going to help us in making sure we set an appropriate cost that we're charging our customers the right price to make sure that we're maintaining our profit margins at the level that we want. And let's move ahead to our next exercise, which is cash collections. So I've mentioned the idea of having a cash budget, the need for a cash budget to make sure that we are meeting our liquidity needs, to make sure that the cash coming in is going to match the cash that needs to flow out for meeting our expenses so that we can pay our bills on time, we can pay our suppliers so they keep selling us product, we can pay our employees so they keep coming to work, we can pay our taxes when they come due, we can pay for our insurance and all the other things we need to pay for. So cash budgeting is a really important piece of this and is something that is very closely monitored by organizations to make sure that their cash coming in matches their cash going out, or at least we have enough. If we only used cash accounting rather than accrual accounting, this cash budget would match our income statement for the most part. We wouldn't need a separate cash flow statement. We wouldn't need a separate cash budget. But we do use accrual accounting. That's what you learned in financial accounting. And so that's why we need to have this cash budget, because sometimes we record revenues not in the same time period that we actually receive the cash. Sometimes our customers might pay us in advance. Sometimes we might allow them to buy on credit. And so that means they're going to pay later. And that's what we're dealing with in this next exercise. Pet Supplies Incorporated, a pet wholesale supplier, was organized on January 1st. Projected sales for each of the first 3 months of operations are as follows. And you can see that this is a brand new business and they're growing pretty quickly. If you are not aware, the single most likely reason for a new business to fail is not because it's not a good idea for a business, but they don't have enough cash. They don't have enough liquidity to meet their needs. They underestimate how much cash they need while they're getting started. Those upfront fixed costs can be quite extensive. And the same thing that we're talking about here, they're selling on account. So they have good sales, but they don't have all of that cash right away. And as you learned in financial accounting in the receivables chapter, it might even be that some of the sales that we record, we never collect that because we take a risk when we sell on credit that some of our customers may not be willing or able to pay us. And so what are we told here? All of these sales are on account. 75% of those sales, though, are expected to be collected in the month of the sale. So that's going to help with our cash flow. 20% is collected the next month, and then the remainder, which would be the last 5%, is collected the second month following the sale. This company is in a really good position. They're making it easy for us. They're not planning for any uncollectible accounts. They expect to collect 100% of their sales revenue, but it's just going to take a little bit of time, up to 2 months. And so we're going to start with January sales. We don't have anything carrying over from the previous year because this is a brand new company. In January, they record on their income statement $300,000 in sales, but they actually only collect 75% of that in cash in January. $75% of $300,000 is $225,000. In January, we expect to collect $225,000 of January sales. Another 20% of that is collected in February. $300,000 in sales, 20% is collected in February, that's $60,000. And the final 5% or $15,000 is collected in March. So what do we see here? On their income statement for their first month of operations, they show $300,000 in sales, but their cash flow statement shows only $225,000 in sales. Their balance sheet contains $75,000 in receivables. They're going to collect it, but they don't have it available to pay their bills in January. So this is a really important part of the budgeting process, is recognizing when the cash is actually coming in and when it's going out, not just when do we record the revenue and expenses. Let's go ahead to February. Obviously, none of February sales is collected in January. We didn't have any customers that prepaid. That would be nice. And for some businesses, that's pretty much the way they do business, right? If you are selling, newspaper or magazine subscriptions, that's all for the most part paid in advance. It's not how it works for this company. So in February, they expect to sell $500,000 worth of pet supplies, but they're going to collect 75% of that in February, or $375,000. So in February, they're collecting that $375,000 from February sales. They're also collecting the $60,000 carryover from January sales, or a total of $435,000. By the end of February, the company expects to have sold $800,000 worth of merchandise, and they expect to collect only $660,000 in cash. You can see the mismatch between what their income statement shows and their actual cash receipts. Again, that's why this is so important to budget, to plan. In March, we're going to collect another 20% or $100,000 worth of the $500,000 that we expect to sell in February. In March, our sales are expected to be $750,000. This company is growing quite rapidly. It's another 50% increase on their sales month to month. And we expect to only collect 75% of that, or $562,500 in the month of March. Add that to the $15,000 that the last piece of the January sales plus $100,000 from the February sales. Total cash collections for March, $677,500. So you can see as the company continues to grow that it gets more and more dramatic, that a bigger and bigger discrepancy as the company gets, I'm going to say, older, more established, more stable. This is going to balance out. And you'll see a much better match between the revenues they record and the cash they receive. But when a company is new, when a company is growing, you're going to see this mismatch, and it becomes very, very important that we're aware of what does that mean when we agree to extend credit and our customers aren't going to pay us right away, and we don't have that cash available to reinvest in our business, to pay our suppliers, to buy more inventory, and so on. Everybody good? Let's move on then. And so we just looked at cash receipts in exercise 8. In exercise 9, we're moving to the other side of the picture, which is how much do we expect to have going out? How much are we spending? Horizon Financial Incorporated was organized on February 28th. Projected selling and administrative expenses for each of the first 3 months of operations are as follows. So these are not product costs because this is a service company. They're not selling a product. These are their period expenses. Depreciation, insurance, and property taxes represent $9,000 of the estimated monthly expenses. The annual insurance premium was paid on February 28th. And property taxes for the year will be paid in June. So let's look at each one of those. Why did they lump these three together and tell us that it's $9,000 total, but they didn't give us the breakdown? How much of that's depreciation, how much is insurance, how much is property tax? Well, here's why. We're not doing an income statement. We're doing a cash budget. We're doing the cash expenditures part of the cash budget. The cash receipts and cash expenditures need to be together to do the entire, to get the full picture, how much is coming in, how much is going out. We're only looking at the cash expenditures part here. And we're only looking at the 3 months ended May 31st, March, April, and May. We're only interested in the cash that's going out the door in those 3 months. So we can see why they didn't include the insurance, because it was already paid before this quarter, this 3-month period started. It will be paid on February 28th. On our income statement, we're still going to show that monthly expense, but we don't have to budget for the cash. It was all paid in February. Same thing is true for the property taxes. They're going to be paid in June, so they're not part of this cash budget. We still would be showing a monthly expense for those, but the cash flow is going to happen at the end of June. In June. Why do they have depreciation lumped in here? What do we know about depreciation that makes it different than really all of the other expenses? What makes depreciation different than all of those other expenses? Mhm.
It's the, was. I'm not sure now.
Okay, that's right. What is depreciation?
Just the cost of something planned out. It's,
Okay, a little more to it. You're not wrong. Just want a little more information.
like if something's supposed to last you 10 years, costs like $10,000, you just divide the cost of something throughout that time.
Okay, I'll go with that. So depreciation is an accounting technique, and this was covered in chapter 9. I know that none of you in this room had me for financial accounting, but I also guarantee in any financial accounting class you took, whether it was here at JCC or any other school on earth, depreciation is part of that class. It has to be. I can't fathom it not being part of a financial accounting course. So depreciation is an accounting technique. It is a technique that allows us to take the upfront cost of some long-term asset. And so the example that Carter just gave, if we buy a piece of equipment that's going to last us for 10 years, we want to take the upfront cost of that equipment and spread it over the 10 years. And the reason we do that is because of the matching principle, which guides a lot of what we do in financial accounting. The matching principle says you record the revenues when you earn them and you match against them the costs that help to generate those revenues. So if we buy this piece of equipment and we're going to use it for 10 years, that equipment is helping us generate revenues. And so we need to take the cost of that equipment and little by little report it as expense throughout the 10 years. When did the cash flow actually happen when we bought that piece of equipment that Carter mentioned? When did we actually pay for it? At the time we bought it, right? And maybe we financed it and we paid it off over 3 years or some other time period, but there is depreciation is not showing paying for that equipment. It's not showing a cash flow. In other words, depreciation is a non-cash expense. And that is why it's lumped in with insurance and property tax here. Depreciation is never a cash flow. Insurance and property tax, for the sake of this exercise, definitely are cash flows. They're just not in the 3-month period that we're looking at here. Okay, so is everybody clear on that? I'm 95% sure that those of you who took financial accounting here on campus in Jamestown in the spring semester with someone else did not cover the cash flow statement because it's chapter 13. I'm pretty sure you guys did not get there. Am I right about that? You didn't get to chapter 13. So it's okay if you haven't really thought about that depreciation being a non-cash expense, but you should recognize that it's not part of the cash budget. It's never part of the cash budget because it's not a cash expense. The same thing is true for depletion of natural resources and for amortization of intangible assets. If you see those on the income statement, they are not cash expenses. They would not be included on a cash budget as we are doing here. And so what's the implication of that? This $52,400 in projected selling and administrative expenses includes this $9,000 in estimated monthly expenses that are not cash flows in the month of March. So how much will be our cash expenditures in the month of March? 52,400 minus 9,000 is 43,400. And it tells us here 70% of that is going to be paid in the month in which they're incurred. So 43,400 in March. Maybe I should make a note on the screen so I don't forget. March, 43,400. April, we're going to subtract 9,000 from what's there, and we get 55,200. And whoops, May, we're also going to subtract 9,000, so we get 59,900. There we go. Okay, so now I've got those numbers, and I can scroll down a little bit here to be able to see our budget. Okay, so in March, $43,400, and 70% of that is going to be paid in March. 43,400 times 70%, 30,380. The rest will be paid the next month. So the last 30%, you can take 43,400 and multiply by 30%, or you could take the 43,400 and subtract the part that we paid in March. We'll do the same thing for April. Of the number I have over here in blue on the right-hand edge, 70% is paid in April, and the other 30% will be paid in May. And finally, for May, I assume that this company is also growing just like the last company, because each month those expenses continue to climb. Big jump from March to April, little bit jump, much smaller jump from April to May. Maybe they're seasonal, I don't know. I have no idea what this company does. Horizon Financial Incorporated, does it say what they do? No, I don't know, maybe they handle taxes. And so that's why their expenses went up in April. Maybe they're just a newer company and they're growing. I don't know. Just guessing. So May's expenses, subtracting out depreciation, insurance, and whatever that other thing was, property tax. May's expenses were about $60,000, but we only included $42,000 here. What happened to the other $18,000? Why aren't we showing it? Does that mean we don't have to pay for it?
It just isn't. I guess it just doesn't have us listed since that month hasn't passed yet.
Okay, so when do we pay that? You're definitely on the right track. When do we pay that? In June, exactly. So we're going to pay that in June. When we go to do the schedule of cash payments for June, July, and August, we're going to include the $18,000 that carried over from May, the 30% of May's expenses that get paid the next month. So why didn't we include part of February's expenses? My assumption is this was a new company in March. If not, does it say? Yeah, there it is, first 3 months of operations. If this was not a brand new company, if it was a continuing operation, then we would have included here the 30% carryover from February. So you always need to keep that in mind. And let's go ahead and add down to come up with our total cash payments for each of these 3 months. Any questions on that? So again, neither one of these 2 exercises was a complete cash budget. We would have to bring these 2 pieces together and then compare. Cash receipts, here's how much is coming in. Cash expenses, here's how much is going out. Do we have enough? And if not, what are we going to do about that? Where are we going to get the cash to do what we need to do? We might have to have a line of credit at the bank. We might need to look at taking out a loan or something like that. This is our last exercise other than exercise 5 that we skipped. So we're going to finish exercise 10 together. And then we will, I will ask you, time permitting, I will ask you to go back to exercise 5.
I had this meeting, I have to be at 3:00. Can I just leave like 6 minutes early?
Whatever you need to do. Yeah, thanks. So I will ask you, time permitting, to go back and do exercise 5 on your own. You'll be able to do that here in the classroom, or do it on your own outside of class before you submit your work. But there's nothing new in that exercise that we didn't already complete. And so let's go back to our last type of budget here. And that's a capital expenditures budget, also known as a CapEx budget. Because we like our acronyms, we like to, in accounting, we like to talk about things that, make us unique. I don't know. So CapEx budget. For many companies, the CapEx budget is really done outside of that master budget that I've been talking about, that includes the operating budgets and the pro forma or budgeted financial statements. The capital expenditures budget is investing in the company. These expenditures don't even look the same on our financial statements as the operating expenses that we've been talking about, the product and period expenses. As I said, many companies run the CapEx budgeting process in parallel with the operating budgets, but outside of that process. So, for example, here at JCC, we might be aware that we have a certain amount of money that's earmarked for capital expenditures. Capital versus operating. Capital expenditures means these are long-term investments in the company. This is the type of equipment and other infrastructure that's going to last us for years and years. Much of what we see on here is going to be subject to depreciation or amortization, like we just talked about. And so at JCC, usually on an annual basis, we receive a note from someone in administration that says, hey, it's time. If you have any capital needs, long-term investment needs, if you have any capital needs for your department, submit your proposals. And so if you need something, for example, if there was some software that I wanted for this lab, if we just needed new computers for the lab, I might make that suggestion. We actually have a proposal out, going to be a proposal out to put a student lab like this back in the Hultquist building. So there used to be labs over there. Right now, there are not any labs. That's why, even though this is a business course, it's over here in the Sheldon building, when most of, or maybe all of your other business courses are in the Hultquist building. There is no lab available for business courses over there. So they put out the request, we say, here's what we need, and then they decide, is it going to fit? Can we afford it? So let's look at this exercise. On January 1st, 2016, the controller of Omicron Incorporated is planning capital expenditures for the years 2016 through 2019. So the next 4 years. The following interviews help the controller collect the necessary information for the capital expenditures or CapEx budget. The director of facilities said, a construction contract was signed in late 2015 for the construction of a new factory building at a contract cost of $10 million. The construction is scheduled to begin in 2016 and be completed in 2019. The VP of manufacturing then said, a construction contract, once the new factory building is finished, we plan to purchase $1.5 million in equipment in late 2017. I expect that an additional $200,000 will be needed early in the following year to test and install the equipment before we can begin production. If sales continue to grow, I expect we'll need to invest another $1 million in equipment in 2019. The COO said, we've been really growing lately. Wouldn't be surprised if we need to expand the size of our new factory building in 2019 by at least 35%. Fortunately, we expect inflation to have minimal impact on construction costs over the next 4 years. Additionally, I would expect the cost of the expansion to be proportional to the size of the expansion. The Director of Information Systems said, we need to upgrade our information systems to wireless network technology. Doesn't make sense to do this until after the new factory building is completed and producing product. During 2018, once the factory is up and running, we should equip the whole factory with wireless technology. I think it would cost us $800,000 today to install the technology. However, prices have been dropping by 25% per year, so it should be less expensive at a later date. And finally, the CFO said, I'm excited about our long-term prospects. My only short-term concern is managing our cash flow while we expend the $4 million of construction costs in 2016, $6 million in 2017. That's the total of the $10 million for the new building on the portion of the new factory building scheduled to be completed in 2019. And so we're putting together our budget. Now, we just talked about that the expense for a long-term asset like this building, the expense would be spread out over the useful life of the building, which is typically about 40 years for a building. But we're doing the capital expenditures, so the actual cash flows. And the CFO told us the construction costs for the building will be $4 million in 2016 and $6 million in 2017. And then remember, we were going to do a 35% add-on to that building in 2019. But they said it would be proportional to the size of the expansion. So if the original building was 10 million and we're adding 35% onto it, we're going to add 35% of $10 million. We're going to plan to spend another $3.5 million to expand the building in 2019. What do we know about equipment? The VP of Manufacturing said, we plan to purchase $1.5 million in equipment in 2017, spend another $200,000 in 2018 to test and install the equipment, and another $1 million in 2019. So that's going to be the CapEx for equipment. If you are wondering, why are the installation costs, the install, test and install, why is that considered a capital expenditure? Well, that is part of the cost of getting the equipment in place, up and running, ready for its intended purpose. And so that actually does become part of the cost of the asset on our balance sheet. That $200,000 also will get depreciated over the life of the equipment. So equipment's not going to have a 40-year life. Maybe it has, I have no idea, a 10-year life. And so as we talked a few minutes ago, the equipment, even though it might be depreciated over 10 years, we have to pay for it in the years in which it's installed and then tested and then when we expand. The last piece then is the information systems. And this is a little bit more math than what you might be anticipating. So the information systems would cost $800,000 today, but the price is falling by 25% a year. So next year, how much would it cost? 75% of what it would cost this year. Price falling by 25%. So if we bought it next year, we would expect to pay $600,000. But we're actually looking to buy it for 2018. And in 2018, we would expect it to go down by another 25%. But this is the part that maybe you didn't consider. It's 25% of the 2017 projected cost, not 25% of the 2016 cost. And so if we do that upgrading to the wireless network technology in 2018, we would expect the cost to fall to $450,000. And so now we have our CapEx budget for the next 4 years. CapEx budgeting normally would fall in line with our long-term plans. We've talked about strategic plans. I mentioned that it used to be companies would typically budget for 5 years out, or would be planning. The strategic plan would go out 5 years. Now 3 years is more typical. And so in this case, they've kind of split the difference, and they have a 4-year plan that would serve to support their long-range goals, that strategic plan that they have. Okay, put my check mark, green check marks in there. Oops. Okay, I missed a 0 there. Typo. So that is the end of chapter 22. As you know, we still have that one more exercise. I want you to complete that on your own. And you're welcome to stay and do that now. We have about 10 minutes left in our regular class time. You're welcome to stay and do that now. I will be glad to stay and answer questions if you have them. But it won't be on the recording. So I'm going to stop the recording at this point.